Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Dave Foster. Thanks for being on the show, Dave.
Hey, Whitney, it's great to be here with you today.
Dave Foster is a real estate investor, 20 years experience. He's a qualified intermediary and 1031 exchange expert who specializes in finding tax strategies for buy and hold investors, including those interested in transitioning to syndication. He's also lived aboard a sailboat for 10 years, and he helps others to reach their dreams, and that's very interesting. I've never heard of anyone doing that. But Dave, thanks so much for being on the show, and looking forward to this conversation. And could you give us a little background on how you got into the 1031 business, or being that qualified intermediary?
Yeah, absolutely. Yeah, I'm not sure if what you mean you never heard, whether it was that crazy to want to move on a sailboat, or anybody ever had. But it's actually, strangely enough, part of my story. When we were living in Denver, more years ago than I care to recall, we had our first child. And right at that same exact time, we were starting to invest in real estate. Now, we did it the normal way everybody does, right? You try and find a rundown piece of property. By the way, that rundown piece of property on Sloan's Lake in Denver that I paid $90,000 for just sold last week for $700,000. So yeah, I wish I would have held on to it.
Wow.
Unfortunately, I didn't. But what I did do was I bought a piece of property, fixed it up, and then sold it. Just the quintessential fix and flip like everybody does. And I was very excited about that, and how that was the start of a new paradigm, until I got my tax bill. And my accountant handed me the tax return. And I said, "Oh my gosh, how can this be? We made money on that." He goes, "Well, not as much as you thought you did, because you're paying a heap of tax on it." And our goal had been freedom for our family, and we wanted to end up on that sailboat. And it wasn't going to happen moving that slow. So right at that time, this was 1996-ish, we realized that we had to change our strategy. And at the same time, there was a major court case that was settled in the U.S. District Court of Appeals to allow investors to change the way that they did 1031 exchanges. Now, for those of you who don't know what those are at all, a 1031 exchange is a process that's been a part of the tax code for 100 years, since 1920. But originally what you had to do was swap properties actually with someone else. It was designed for farmers, heavy equipment operators. Well, you can imagine in today's market how tough that would be. The court case that was settled allowed investors then to simply sell real estate that they held for investment and purchase new real estate that they held for investment, and they didn't have to pay tax in the middle. As soon as I saw that, the light clicked on. I was like, "Oh my gosh, this is it. I can continue my practice exactly how I do it. But as long as I'm using the 1031, I get to use the tax dollars to build my portfolio as well." And so that was the start of everything. The start of me doing 1031 exchanges for myself. And I had some friends that said, "Dave, we're setting up shop. Why don't you come in and join us?" And so looking back now 20 years later, here we are still doing 1031 exchanges, still saving tons of tax dollars. And I did get my 10 years on this sailboat.
Nice. So, you refer to yourself as a qualified intermediary. Can you tell us, how do we find somebody like yourself, and how do we know they are technically qualified, somebody that we work with?
Yeah, well, first of all, the qualified intermediary is a requirement for a 1031 exchange. You must use the services of an unrelated third party. The only role that we fill in your transaction is the documentation and the processing of the 1031. So an investor uses all of their normal professionals, realtors, attorneys, accountants, title companies for their transaction. The qualified intermediary is a third party that handles just the 1031 portion of that transaction. And Whitney, here's where the other shoe drops. Qualified in IRS speak only means that I'm not disqualified. And I'm only disqualified if I'm a blood relation to you or if we have a prior business relationship. So qualified intermediary, although it sounds very noble, I'll take the title. It really just means that I'm unrelated to you. So your question about how do we know who we're trusting or does this person know what they're doing isn't so simple as looking for the Q and qualify. You've got to vet that person out to see what kind of real background that they've got, demonstrated experience, and safeguards for the customer. Honestly, most qualified intermediary firms that only do that are made up of attorneys and accountants like ours. There are attorneys that'll do a few every year. There may be accountants that do a few for a year, but they're never going to do them for their clients. So it is kind of you got to do a search to find them, but there's a few of us out there that are the national firms, and that's all we do.
That's interesting. And, before the show, you and I were talking a little bit about this, and I really like to focus on, just the, that investor that is probably listening that maybe has a few rentals and they're looking to get into either syndication business, but really maybe they want to go even passive or just that life cycle of an investor that you and I discussed.
Yeah, absolutely. I've got a theory. I don't know how we'll ever prove it or not, but my theory is that more people enter into real estate investing because they get married than any other reason. I have no clue how we'll prove that, but here's why that works. The greatest amount, we all know that we're getting married later and later in life now. And so when two people get married, so many times, he's at a house and she has a house. And they move into one of them as part of their marriage. And now what did they just become? Real estate investors, because they've still got the other house. And I see it time after time. We call them accidental investors. But it's kind of like a drug that gets in your system, this real estate investing thing. You mean I get a monthly rent paycheck coming in? That's kind of a cool thing. So over time, what do? We want more and more of it. So we start buying more properties. And that's a great way to use the 1031 exchange. Because when you sell, say, a $200,000 piece of property, you can use the proceeds to go buy two $100,000 pieces of property. So you can diversify and acquire more properties more quickly. So the 1031 really helps to build. And we help our investors doing that quite a bit. But sooner or later, Whitney, one day, you'll wake up and you're tired. And you don't know why until the first phone call of the day comes from the tenant with a plumbing issue. And the second phone call comes from the tenant who fell on the ice in front of your house. And the third call comes and you go, oh, that's why I'm tired. I've got 20 different rentals here and it's killing me. And I did this so I could enjoy life. So again, the 1031 exchange can be used to do what we would call consolidate a portfolio. Sell two properties, each for $200,000, and go buy one property for $400,000 and start to narrow your horizon, start to minimize your the costs and the effort of management, and start to give yourself a life. And that ebb and flow is what we call the life cycle of a real estate investor. It starts out growing more and more active, and then as you get towards the latter stages of it, the focus becomes on minimizing distractions, maximizing passivity, and creating income streams that sooner or later aren't going to require you. And that's kind of the world where you and I both live. From the 1031 perspective, it involves selling and positioning assets. On the syndication side, that's one of the types of assets that can sometimes work.
So let's focus on that person who has, whatever their portfolio is. Maybe they've built it to 100 single family homes, and now they've said, okay, I've had enough of this, and I want to just invest in somebody's syndication, as a limited partner, or can they use the 1031 to do that?
Sure. Yeah. Well, that's kind of the crux where we get to what the big problem, the big issue, the roadblock is in that. Because with 1031, you can use it to move into different properties, hire property managers. Okay, that's fine. But sooner or later, you realize you're having to manage property managers. And that's not so much fun. You can take 1031 exchanges and you can move into fixed assets that are triple net commercial assets where the tenant pays all of the taxes, insurance, and maintenance. That's a very passive way of investing. The problem is the price tag on those can be very, very high. You can also go into it's now relatively new class in the last 15 or 20 years, which are fractional passive commercial investments. Triple net leases, where instead of having to buy the whole building, you're buying a part of that building. And that can accommodate a 1031 investor who doesn't have the full amount necessary. Now, the key in all of those scenarios is that the investor is selling real estate and actually buying real estate. Even when it's a fractional ownership, they're buying a tenants in common interest in the real estate itself. And that's what makes it work with 1031. You have to sell real estate, you actually have to buy real estate. So there's the problem with syndications. Most, or actually with 1031 working with syndications, most syndications, the way they're set up now, and by the way, you haven't been doing this for very long because you look like you're about 20 years old. But back in the old days, syndication was kind of used in a whole lot of different ways. We called them partnerships. We called them joint ventures. There was a whole lot of names. The pure idea of a syndication isn't anything necessarily new. But what is new, or relatively new, is the new structure that syndications are being created with. And most of them are going the legal route of a limited liability partnership with a general partner and limited partners. Some are being done as LLCs as well. Now, they're doing that for a variety of security, financing, all sorts of reasons. But what that's done now is it's put a limitation on the 1031 investor. In the old days, if I wanted to create a two-person syndication, I would simply have the other investor and I purchase the property together as tenants in common. With the new structure of syndications, they're being set up as limited partnerships. What I have to buy is not the real estate itself. I'm buying a membership interest in the entity that owns the real estate. And unfortunately, that doesn't qualify for 1031. So the 1031 investor has a couple options that they can look at. Certainly they can say, you know what? I've had a good run deferring the tax. Maybe it's time to sell this one, pay a little tax hit, and go into syndication with my now tax-free dollars. And that can be a good avenue to do it, particularly if you've got a sharp accountant and you can work with them and say, oh, here's some capital losses we can offset that with. Now, in order to make this work, you got to have capital losses, so it's not a strategy I recommend, but it will work. Another option would be to do a variation on what some people have coined the BRRRR method of reinvesting. The BRRRR method is where you purchase an asset, fix up the asset, rent the asset, or rehabilitate instead of fix. Rehabilitate, rent, and then refinance. So once the asset is stabilized, you now have some built up equity in it, you refinance. Now that is a perfect opportunity to then take those tax-free refinance dollars and move them into a syndication, because those dollars can be used to purchase have an entity or a portion of an entity that's going to real estate.
Nice. Are you tired of answering emails from investors about when they'll receive their K-1s? Let the real estate CPA handle the accounting and taxes on your next syndication, and they'll file your tax returns by March 15th so you can get your K-1s to your investors by the individual filing deadline on April 15th. Not only will this reduce headaches, but it will help you retain investors over the long term by improving investor experience. The Real Estate CPA is now offering a special virtual workshop to the listeners of the Real Estate Syndication Show on how to answer tax-related questions from your investors. Learn more today by visiting therealestatecpa.com/syndication. So can you walk us through a little bit of a timeline? Maybe when should we contact somebody like yourself, if we are looking at making that happen?
Sure. It's going to involve a transition, of course. So the 1031 exchange itself, which may be the trigger to the process, starts with the closing of the sale of your old property. So you market your property like you normally would. Once you have a contract on it, you contact the qualified intermediary that you want to work with, and then they start working with the title company or the attorney that's closing the sale. From the day that you close the sale, you have 145 days to identify your potential your replacement, and 180 days to complete the entire process. So at some point during that time, right, you'll find your replacement property. And then at that point in time, it's how quickly you can refinance it. Now, the key for people wanting to go into syndication, again, remember, it's the returns and it's also the effort, is that you're going to want a 1031 also into a property that's not going to cause you management headaches. So something that's value add, where you can get the benefit of equity to pull out. Something also that's not going to take a lot of management once you get it going. Perhaps something you could do a triple net lease on. Something like that. Whenever that's stabilized and you can then refinance, that's the step that you take. And then you contact your favorite syndicator and you end up placing the money with the syndicator. Now, what you're doing when you do that is you're actually kind of double dipping, aren't you? Because your tenant is paying your mortgage. So although you pulled refinance dollars out, those dollars are a non-consequence to you because the property you borrowed against is still cash flowing, is still generating income. Meanwhile, here's tax-free dollars now generating income inside a syndication. It can really be the best of both worlds when structured right.
Nice. So what about any ways to use this from our, primary residence? And even what's the best ways you've used it, or have you used it from moving from one house to another, or how have you used it?
All right. Well, that's actually, let's go back to the sailboat story, because that's actually how we got the sailboat.
I was wondering.
Well, there's actually two parts of the tax code that deal with real estate. 1031 deals with investment real estate, and Section 121 deals with your primary residence. Now, when you sell the investment real estate, you do the 1031, you're deferring tax. When you sell your primary residence, if you've lived in it for 2 out of the previous 5 years, then you get to take the first $250,000 or $500,000 if you're married in profit tax-free. And you can do that once every 2 years. So how did I get the sailboat? It was as simple as I would buy a piece of property. I would 1031 it wherever I wanted to end up living. I would use it for investment for a year or two. Then I would move into it. And then 2 years later, I would sell it. I would take the money tax-free. I put that into the boat fund, and I would do a 1031 into something else. And over the process of doing that several times, we actually carved enough cash out to buy the boat tax-free. So and you can do the same thing if you want to invest in syndications as well, because it's as simple as when it's your primary residence, it's tax-free. You can sell it and do whatever you want. Well, Why not sell that, take the money tax-free, and move into one of your investment properties? I have a realtor on St. Pete Beach here that actually has 3 beachfront properties that he has 1031 into over time. That is his entire retirement plan. When he's done doing what he's doing, he's going to move into the first one. Now, when he does that, a couple things happen. First, he can sell the home that he has right now, and that's all tax-free. So there's his living capital for a while. Secondly, whenever he's ready, he will then sell the house that he's converted. Now, since 2008, the rules have changed just a little bit, and he won't get all of the profit tax-free, but he'll get a good chunk of it tax-free. So, and that's probably a discussion for another day. But when that happens, he's going to take some of it tax-free. He's going to take some of it and pay the tax on it. Where's he going to move, Whitney?
Into the next one.
I asked his wife, are you okay with this deal? She said, well, yeah, whenever it's time to redecorate, we're just going to move.
So what about costs associated with doing something like that, or, the 1031 and working with somebody like yourself?
Yeah, a good 1031 exchange isn't going to cost you more than $750 to $1,000. It's usually very noise level in the transaction. And most qualified intermediaries actually put that fee onto the settlement statement of the closing. So clients never have to write a check. So it ends up being something where cost is always a deal, but you can generally save an awful lot more in tax than you would have paid in the cost of a 1031.
What are some of the biggest or common mistakes that people need to avoid when doing a 1031?
Well, the single biggest thing that'll sink your 1031 is the timing issues. In particular, the 45-day period, because you've only got the 45 days from the day that you close the sale to produce a written list of your potential replacement properties. And there's some limitations on the size of that list. So if you wait to start your shopping too late, you're going to be under the gun. So I would say that's probably the single biggest pitfall that people come into. Now, regarding syndications, I get the question all the time, and I'm sure you do too. I've got this property I want to sell. I want to move into a syndication. The single biggest roadblock to that, like we talked about earlier, is the LP structure. And if someone tells them, oh yeah, you can go into our syndication, and they bank on that without doing the due diligence, you come up to day 44, and all of a sudden you don't have a property that qualifies. So it's real key that they want to be interfacing with us so that we can make sure that the structure of the syndication works. Because interestingly enough, and I know you're seeing this as well now, there's a brand new, not a brand new structure, but there is a emerging structure for syndications because people are wanting to start to capture $1031. And this growing number of syndications are actually setting themselves up as tenants in common structure. So you can buy a small piece of a large syndicated asset that's going to be value added, it's going to be stabilized, it's going to be managed, and then it will be sold. So it's possible now, but again, you have to look to find them. I know that you've been talked to by people as well who have those. It's just that you've got to do the due diligence to find those that will work with 1031. Either that or the LP syndication where there's a commitment to selling and then 1031ing the entire asset as an LP into the next property. Both of those will work with 1031 investors, but that 45-day period kind of puts a sense of urgency in it.
Yeah. So, many syndicators will try to have another property lined up. Obviously, when they exit one, they'll 1031 into another. So,
Exactly.
as being a LP or, limited partner or the passive investor, what work is required on their part during that process, or is there?
Well, that's actually the beautiful thing about it is that the 1031 can be done by any tax-paying entity, and it acts exactly the same. So whether it's me selling a little duplex or a limited partnership selling a large apartment building, that limited partnership is a tax-paying entity. So it is the taxpayer for that apartment building. It could do a 1031. So if they have lined up and have their next property under contract, they simply perform a 1031. All of the members of the LP now own an LP that owns a different piece of property. And there's all kinds of deferred tax in it. So once you get on the train, it's a pretty easy ride. It's a question of how you get there first by minimizing your tax hit.
Nice. So Dave, what else do I need to ask you about 1031 exchange, reference syndication that I wouldn't even know to ask you? What else does a listener need to know?
Wow, that's a loaded question. I would say probably the single biggest factor that I've seen in the success that we've given taxpayers to get into syndications using 1031 exchanges is when they involve their syndicator and the QI quickly and early on. Because there's so many things that syndicators can do now to make the property qualify by creating a tenants in common structure or by eliminating it early on and letting that taxpayer move into different properties. The field has gotten so big, hasn't it, that there's now syndicators that have multiple properties with multiple structures going on at any one time. And as long as we know ahead of time, as long as they know ahead of time what the client wants to do, then it's as simple as Dave and Whitney getting together and seeing which structure is going to work best for that client. But that's probably the single biggest factor is early and frequent communication. And as long as you've got that, you can just about always make something work.
That's great, Dave. You've been a great guest. I really appreciate your time. Would you tell the listeners how they can get in touch with you?
You bet. You can always catch me at our educational portal, which is the 1031investor.com. And my email, of course, is very simple. It's Dave at the 1031investor.com.
Nice. Thank you so much, Dave. And I hope the listeners have learned a lot about 1031 exchange and how that relates to the syndication business. And I hope you'll connect with him. And especially if you're selling a property soon, reach out to him and also reach out to me on the website, schedule a call and see if I can help you in some way, and join us on the Facebook group so we can all learn this business together and learn from people like Dave. And we will talk to each of you tomorrow.
Thanks so much for having me, Whitney.
I want to tell you about an upcoming real estate investing conference hosted by my good friend, Joe Fairless. Every February, Joe brings his best ever conference to Denver, which brings together the top high-level experienced real estate speakers and sponsors that has proven to be the best ever networking, content, and strategies to help grow your portfolio. The earlier you buy, the more you save. Ticket prices increase weekly, so you want to buy today. I attended in 2018, and I can guarantee you do not want to miss this conference. February 22nd and 23rd, 2019 in Denver. Go to besteverconference.com to reserve your seat today. That's besteverconference.com and use hashtag Whitney to save 10%. That's hashtag Whitney.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.